So the future is really, really right now, in my opinion, divided upon age because we're such unstable times right now. And we're just talking again before the show started. The problem is our money. Money is fake money today. So if I was a younger generation person right now, I would be giving all my money to Kenny. Not really, but I would. Right now, what you're going to need is income. Because AI, artificial intelligence, is going to wipe out thousands of jobs, millions of jobs. And so the idea of, job security is a myth. Retirement security is a myth. And what do you do with kids and older guys, boomers?
A bombshell study just dropped, revealing that 1 in 3 millennials now expects to be permanently unemployed by 2030. The current economic situation is causing significant concerns for different age groups. The younger generation is facing challenges due to the unstable times and the potential loss of jobs to artificial intelligence. On the other hand, the boomer generation is worried about retirement security and the potential need to rely on their children for financial support. The future of individuals is heavily influenced by their age and the financial challenges they face. Here are some key pointers to consider. The boomer generation nearing retirement is at risk due to the instability of the stock market. This can have a significant impact on their financial well-being. The median generation, caught between supporting their parents and raising their own children, faces the burden of financial responsibility from both ends. The younger generation needs to focus on generating income as job security is becoming increasingly uncertain. The rise of artificial intelligence threatens to eliminate thousands, if not millions, of jobs. If you're finding value in this video, don't forget to subscribe to my channel. Job security is no longer guaranteed in the current economic climate. Here are some important factors to consider. Artificial intelligence is expected to replace numerous jobs, leading to increased competition and a higher risk of unemployment. The concept of job security is becoming obsolete, and individuals need to adapt to the changing job market. The younger generation should prioritize income generation to ensure financial stability in the face of job market uncertainties. Retirement security concerns. Retirement security is also a major concern for individuals of different age groups. Here are some key considerations. The boomer generation approaching retirement may face challenges in securing a comfortable retirement due to the instability of the stock market. The younger generation needs to plan for their own retirement, as traditional retirement security is no longer guaranteed. The potential need to financially support parents or older family members adds an additional burden on individuals, especially those in the median generation. In 2021, the median income took up 31% of the total income for housing. In 2023, this percentage increased to 41%, indicating a 10% increase in just 2 years. Inflation has caused the value of money in people's bank accounts to decrease over the past 2 to 3 years. This increase in value further exacerbates the impact of rising housing costs on affordability. The impact of the US dollar on global inflation. Countries that use the US dollar as their currency do not experience the same level of inflation as countries with their own currencies. When the U.S. economy expands and the Federal Reserve prints more dollars, it spills over into other countries' economies, causing inflation worldwide. Despite this, the U.S. dollar remains a stable currency and continues to flow back into the U.S. To protect against inflation, it is advisable to invest in assets that cannot be easily printed or manipulated by central banks. Examples of such assets include gold, silver, Bitcoin, and income-producing real estate financed with debt. These assets have been a successful formula for wealth preservation and growth. Continuous study and analysis of the financial markets and economic trends are crucial for making informed investment decisions. Bonds are currently seen as a significant risk due to certain factors. It is important to stay updated and adapt investment strategies accordingly. Financial planners often recommend a balanced portfolio consisting of a mix of stocks and bonds. The typical allocation is 60% stocks and 40% bonds. This allocation is considered safe and helps to mitigate risk. Market crashes and the role of the Fed. During market crashes, such as the one in 2024, financial planners have relied on the Federal Reserve, the Fed, to intervene and stabilize the market. However, there are concerns that the Fed may not be able to save the market in future crashes. Age and financial planning. The future of financial planning depends on an individual's age. For baby boomers and older individuals, there may be concerns about their financial stability in the next 5 years. Younger individuals may also face challenges such as job security as older generations retire. Planning for the future. It can be challenging for young individuals who are still figuring out their own financial situation to plan for the financial future of others, such as children. The S&P 500 is often used as a benchmark for various financial indicators. Both the bond market and the S&P 500 are expected to experience a crash. The S&P 500 includes companies like Auto, Amazon, and Apple, which are likely to be affected by the crash. Buying stocks from these companies at the bottom of the crash could be a good investment opportunity. However, older individuals in their 70s and 80s may not be able to afford the potential crash. Cash flow and alternative sources of income. For young individuals, having a steady cash flow is important. It is advisable to seek alternative sources of income rather than relying solely on a job or the bond market. Real estate is one example of an alternative source of income that can provide cash flow. Depending on a job or the dividend market may not be sufficient for long-term financial stability. Concerns about banks and commercial real estate. Banks are facing serious troubles, particularly in relation to commercial real estate. The current situation poses risks and uncertainties for the banking sector. This could have implications for individuals who have investments or savings in banks. It is important to stay informed about the state of the banking industry and its potential impact on personal finances. Using debt as a tool to build wealth is a concept that goes against the traditional advice of financial planners. However, it can be a powerful strategy when used wisely. This approach involves borrowing money at a low interest rate and using it to invest in assets that generate a higher return. In this way, you can leverage other people's money to grow your wealth. Benefits of using debt. By borrowing money at a low interest rate, such as 3 to 4%, you can potentially beat inflation and increase your wealth over time. Debt allows you to invest in assets that have the potential to generate higher returns than the interest you are paying on the borrowed money. Using debt strategically can help you build a diversified portfolio and increase your overall wealth. Examples of using debt. By taking out a mortgage to purchase a property, you can benefit from the appreciation of the property value over time. The rental income generated from the property can also contribute to your cash flow. Margin trading allows you to borrow money from your broker to invest in stocks. If the stock prices increase, you can make a profit that exceeds the interest you are paying on the borrowed funds. Taking out a business loan can provide the necessary capital to start or expand a business. If the business is successful, the returns can outweigh the cost of the loan. Risks and considerations. Debt comes with risks, such as the potential for interest rate increases or the inability to repay the borrowed funds. It is important to carefully assess your financial situation and have a plan to manage the debt. Using debt to invest in volatile or high-risk assets can lead to significant losses if the investments do not perform as expected. It is crucial to have a solid understanding of the investment you are making and to conduct thorough research before using debt to invest. Brent Johnson highlights the bond market as the largest market globally, emphasizing that the dollar's strength is intertwined with debt. The dollar essentially exists because of debt, primarily in the form of bonds. Since the Federal Reserve's establishment in 1913, the financial system has revolved around debt, urging individuals to get out of debt while operating on borrowing principles, much like the Federal Reserve itself. Contrary to many financial planners, figures like Robert Kiyosaki prioritize borrowing when needed, a strategy resembling the Fed's approach. However, they caution against investing in certain assets like REITs, real estate investment trusts, which include large office buildings, warehouses, and shopping centers. These properties face challenges due to technological advancements. Remote work reduces the need for offices, while online shopping diminishes foot traffic to physical stores. AI's rise adds another layer of uncertainty, especially for younger generations. AI's potential to outperform teachers in education raises questions about job security, challenging conventional career paths like teaching. This uncertainty extends to older generations too, as they ponder the survivability of their retirement funds, such as the 401k, in the face of potential market collapses predicted for 2024. The interdependency of the S&P, bond market, and real estate creates a precarious situation, where a collapse in one sector could trigger a domino effect across the others. In 2024, people should consider various factors when planning for the future. Age and financial situation play crucial roles, and preparation varies accordingly. Education remains important, but age becomes a significant factor in the coming years. For families, financial stability is a key consideration. Questions about supporting family members financially or dealing with potential economic uncertainties become more critical. The impact of emerging technologies like AI on job markets raises concerns, especially for younger generations. The possibility of global conflicts, such as those involving Israel and Ukraine, adds another layer of uncertainty. Considering these uncertainties, it's advisable to be cautious about investments that can be easily influenced by external factors. Prudent choices include assets like gold, silver, Bitcoin, and income-producing real estate. This strategy has remained consistent for Robert Kiyosaki for several decades, providing a sense of stability amidst the uncertainties of the times. For deeper financial insights, subscribe to WealthMap. Thank you for joining us on this journey of learning. Until next time, remember to begin with small steps, dream big, and stay financially empowered as you shape your future.